Hi folks, Rick Wedell here. I'm the Chief Investment Officer at RFG. Thought we would come to you today with a brief market update, kind of let you know what's going on out there. S&P 500 right at about 62.55. That is up about 6.5% year to date, with really kind of a strong rally here in the last couple of days since June 20th, over the last 2 weeks. Market almost 5% over that time frame. And if you think about it, we're sitting here in early July with the market up about 6.5%, and you would look at it and say, hey, it's actually a pretty good start to the year. Equity markets generally we think about returning maybe about 10% a year. The fact that we're up about 6.5% through the beginning of July is actually a pretty strong start to the year. And it's a great reminder that markets don't always just go sort of straight up into the right. We obviously had some difficulties, if you will, during the April timeframe. Big sell-off, big rebound, but that is the way that markets generally move. To check in on a couple of other asset classes, you've got the Russell 2000, which is your sort of small mid-cap stocks. Those are about flat year to date. You've got international markets, really the rock star of global equity markets. The ACWX US up about 17% year to date. And then you've got bonds represented by the Barclays Ag, also having a pretty good year, up about 2.5% year to date. So generally a pretty good year across asset classes. Dominating the headlines right now is fiscal policy. We have the passage last week of Trump's sort of big, beautiful bill, which is largely an extension of the Trump 1.0 tax cuts. So yes, there are some new features in here. There's some minor things around the edges. You've got some deductions for things like tips and overtime income. You've got a bump up in the state and local tax deduction rate, a $6,000 deduction for some older adults that are making less than $75K a year. These are very sort of marginal at the edge type things. It's estimated that, sort of wealthier Americans are probably the biggest beneficiaries, making, maybe they'll save about $12,000 a year on taxes. To pay for this, in theory, there is some work requirements that are being put in place for the receipt of Medicaid and food assistance programs for some adults, not necessarily everybody. This has been sort of a key linchpin of Republican policy for a long time, is this sort of, tying your eligibility to being working. 80 hours of work per month in order to qualify for these things. It's anticipated that, the reduction in spending associated with certain people not being able to do that or not choosing to do that will pay for a portion of the bill. However, the vast majority of the bill will be paid for by continued deficit spending. So there's roughly, we'll call it, JP Morgan coming out this morning and saying that they expect deficits as a percentage of GDP to grow to about 7% of overall gross domestic product between fiscal year 2025 and fiscal year 2026 for the government. Continuation of the deficit spending levels that the government has been going through, unless the government decides to do something about that here in the next year or two. On the other side of the fiscal policy coin, we have what's going on with tariffs. The administration announcing last week that they were going to start mailing out letters to the various trading parties that are out there to inform them of what their new tariffs rates would be as of August 1st. The market not really reacting too strongly either way to this, because I think it's still uncertain exactly what will happen there. August 1st is a long way away. We don't really have a lot of clarity on what everybody's individual tariff package will look like. But long story short, most economists looking at it right now and saying maybe we get a little bit of stimulus from the, big, beautiful bill. Much of that stimulus will probably be washed away by the future impact of tariffs on overall consumption level and overall economic growth. So most economists kind of looking at this a little bit of a wash. If we turn our eyes away from fiscal policy and towards more just how's the economy doing, key piece of data last week was the unemployment rate, which we got out on Thursday. There we saw unemployment actually cool to about 4.1%. A movement in the right direction. And that really, I think, has convinced the bond market participants that the Fed is going to be on hold here for a while, which is not a bad thing. We continue to be in a little bit of this Goldilocks scenario of inflation doesn't seem to be that bad of a problem, but unemployment also does not seem to be that big of a problem. And so long as those two don't seem to be flashing any types of warning signs, there's no real reason to do anything with respect to monetary policy, which is where the Fed's head is right now, which is a good thing. Once again, we love that Goldilocks idea of not having to use monetary policy to try and solve a problem. The absence of a problem is actually quite a good thing, which is, we believe one of the reasons why the market has been up here in the past couple of weeks. So with that, as always, if you have any questions, please feel free to reach out to myself or to your advisor. I hope you're having a great day, and I look forward to talking again soon.